Hello, I'm Adam Grimes, and welcome to the Interactive Brokers Introduction to Technical Analysis course. This is Unit 4, and we're going to be talking about bands and channels and how to use them. Quick outline of what we're doing here. We're going to look at basic concepts behind bands. We're going to look at some of the different types of bands, options for setting them up, and we're going to look at a specific way to use them to quantify overbought and oversold conditions in markets, and then we're also going to talk about what bands can tell us about momentum. So why would we even use bands or channels at all? Well, if you look at the market data on your screen, and we already talked about building the chart up from the data flow. Yeah, now we have divided the chart into time periods, and we can see that it's kind of going up and kind of going down in places, but can we say anything else about the market? Well, one helpful thing is a moving average, which we've also discussed. It might be useful to have some idea when the market is far away from a moving average, as it is in these places, or when it is relatively close to the moving average, as it is in these places. But of course, the problem becomes, how far is far away? What does far away mean? One of the ways that we can answer this question is to use channels. And what you see on your screen here is something called Keltner channels. These are set 2.25 ATRs, so 2.25 average true ranges around a 20 period simple moving average. And what you can see is that sometimes the bands are relatively narrow and sometimes they are wider. They adapt to the market's volatility. As the market jumps around more, which is one way to think about volatility, then the bands widen to accommodate that. In quieter market conditions, as we have on the left side of the screen, the bands are smaller to also accurately reflect that. Why do we care about this? Well, one of the reasons is because if we look at market conditions, we see that markets behave differently when they're in relative equilibrium compared to when real momentum is driving those markets. We get a different character of market behavior. And looking at how close or how far the market is to moving average is one way to understand momentum versus equilibrium. If the market is relatively in balance, then it makes sense that it will probably be close to a moving average. And bands give us a structured and consistent way to measure this distance from a moving average. Now, I just showed you a specific kind of band called a Keltner channel. There are some others. Probably the one that is in most common use is Bollinger Bands. This takes a moving average and it offsets the channels by a multiple, usually a multiple, of the standard deviation of price. Keltner channel, which we mentioned, is offset by a multiple of the average true range. Another possibility is a moving average channel, and the first two are sensitive to volatility. Moving average channel is not. It simply puts bands a certain percentage above or below the moving average. And you may think I'm being a little bit vague when I say offset by a factor. Well, that's an input that you can play with. Everything is customizable. You can pick what window you want to look back to measure the volatility, and then you can pick what multiple you want to use to tell you how far to set the bands away from the moving average. And you will see that to some extent, this is a reflection of your style and your chosen approach to the market. The better you understand the tool, the better you understand what it can do, what it can't do, and why some might work better than others. I'm going to just show you here. Here are Keltner channels, which you've already seen, and for comparison on the slider Bollinger Bands. And you can see they're similar, but different. I'll just flip back and forth between the two so you can see. The way they respond to the market's volatility is different. And if you were to look at places where the market touched the bands, you would see that it's different for different measurements, which of course makes sense. One of the ways that people use bands is to think about overbought and oversold. Now, we need to be careful. This is an important concept in technical analysis, but it also can go wrong if we're not careful. We need to guard against the thinking that says if something is overbought, this means that it has gone up too much and it means it will come down. When we start using words like will and must, these words don't exist in trading and in markets and in analysis. Why? Because everything we do, this is why we structure this like this, everything we do is simply a shift in the probabilities. So there is no certainty. If we're looking at a market that is overbought, the best we can say is that it's potentially maybe overextended to the upside, maybe due for a sell-off. And if we analyze, if we were to go back and look at many conditions where this has happened in the past, we could derive some stats. So we would know that when these conditions occur, this is more likely to happen over this time window. And that's one way people build trading systems and seek to understand the market. That's overbought. Oversold is the reverse. It simply means it's gone down too much and could be primed for an upside reversal. So just to really stress the point here, be very careful anytime in your thinking you think about will or must, because everything we're doing is really just about probabilities. You do want to be careful when you start playing with overbought and oversold. There can be considerable risk here because these overbought and oversold points will often come in strong trends, and these strong trends will often have extreme volatility. So if you're on the wrong side of a move, if you can imagine, and I'll show you in a moment, a market that is going up very strongly, and if you were to go against that by shorting and it continues to go up, you could find yourself on the wrong side of the market. Now, you need risk control, you need a whole trading system built around this concept. Does not mean the concept is invalid, but you really can't, you probably cannot use overbought and oversold in a standalone capacity. One way to think about it is, as I've written here at the bottom, that overbought markets can get more and more overbought, and they can stay overbought longer than anyone might expect possible. Here is the Dow Jones Industrial Average, and if you were simply to say every time it touched the upper channel, it was overbought, well, you would have found that it got overbought and got more overbought and more overbought and more overbought and continued to go up. And yes, there are other ways that we might measure the overextension or overboughtness, if you will, of a market, but this is one indication. And this issue of being on the wrong side of a strongly trending market happens in any kind of mean reverting trading, something you need to be aware of. Switching gears just a little bit to think about momentum. So this is an important word, and it's confusing sometimes to talk about it because people use the same word to mean different things. Several definitions that you will hear. It simply can be the difference between two closes. This is a standard indicator in technical analysis, which simply looks at the point or pip or dollar change from day to day in an instrument. One of the other ways we use the word momentum is to look at the acceleration or the deceleration of the change of prices. And we can see this sometimes in indications like the slope of a moving average. If a market is going up and then it starts to go up faster, we would say momentum is increasing. Momentum is also used in portfolio investing as a factor. It's the tendency for strong assets, for leaders relative to other assets, to continue to become stronger. And momentum also can simply be used to mean the tendency of prices to continue to move in one direction. The offsetting force against this is mean reversion, which is the tendency for prices that have made a large move in one direction to snap back in the other direction. And understanding this interplay of momentum and mean reversion is really one of the critical things to understanding how markets move. And I'll just show you an example here. If we can flip the idea of overbought on its head and say that when a market touches the upper channel, it is experiencing strong momentum, then we can expect to see some follow through. And you'll see that's another way to use channels, just to indicate when a market has generated enough momentum to move away from the moving average, to show that the move is somehow, quote, real, as opposed to simply noise around the moving average. And these are just introductions to these concepts. You're going to need to think about these and do a little bit of exploration on your own and figure out how you want to trade. But however you trade, you will definitely deal with these two forces of mean reversion and momentum. Quick summary here. Bands or channels are one way to precisely define and to measure the distance that a market has moved from a moving average. We looked at some different ways to structure and use bands or channels, Bollinger Bands, Keltner channels, moving average channels, and the ways to use them either to indicate a point where a market is overextended or conversely to indicate a point where a market might be experiencing real momentum. And 3 very important concepts you should carry away from this video would be this idea of overbought, oversold, the idea of momentum, the idea of mean reversion, and how these last 2 play off and work against each other. That is all I have for this unit. I will see you back for the next unit.